Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Primary Vision Frac Spread Count. So we're going to talk about the activity that we've seen. What are some of the things that are coming down the pike when we're looking at going forward through the summer? And then, so we did a show that we actually titled "Why Last Month Wasn't Peak Inflation." So we have an actual show titled that. But now we're gonna go through why we were right and where inflation currently is, because it came out hot out of the gate, and what we see going forward. And then obviously we'll do a deeper dive when we get into our econ show next week. So with that being said, we want to look at what is happening on the frac spread count. So you can see here that we went from 279 to 283. So we essentially just reversed what we went down from Memorial Day weekend. And this is what we were talking about last Friday, where typically you get a slowdown post Memorial Day, that long weekend, and then as things come back, then you start to come back up. So we increased by 4. Again, nothing too crazy, because the increases didn't happen in the Permian. They happened in some of the other ancillary areas, as well as the Western Gulf continues to be strong, but the Anadarko. So some of the ones as we go forward, if you remember, we've been talking about really that trajectory to 290 and then onwards to about 300. And we're still on pace, because it's June 10th. We have another 20 some odd days to get there. And realistically, another 7 spreads is not crazy to see, especially given where we see some of the activity and what we're seeing on the ground, which is, again, that robust move, everything starting to get into place to make that push through the summer months, which again is very seasonally normal. And some of the things that we're seeing along those lines, and we're going to talk about some of the big drivers as we go forward to kind of support that view that we are going to get to that level. Now, just as we saw with frac spread counts, the frac spread count, there was also an increase on in the U.S. of 6 rigs. If you remember, there was things were kind of flat, and then when you look at directional, horizontal, vertical, it was 222. So everything is coming right into play when you look at activity, making sure that the ducks are there, making sure that those things are coming along. But rigs have accelerated while frac spread count, the frac spreads have been kind of oscillating a bit and just going sideways. We do expect that to accelerate as we come into the end of June and again into July. But rigs never really slowed down, and that's where we start talking about the duck count and making sure that there's the available capacity to come on board. Now, when we look at what happened with Freeport LNG, the fire looks like it was due to a leaky valve or a leaking pipe that resulted in the fire. They have declared force majeure through the end of the month. So, will it take 20 days to come back? That is going to be something to see. But you might think, well, what does that do to the frac spread? What does that do to activity? We do have a heat wave that is striking a large part of the U.S. So even as those exports go away for the time being, we still have a lot of spare capacity and storage, and we will have more of a burn because of the heat wave when we think about electricity, AC consumption. So it's not like it's going to get lost, and we don't see an impact to production in general. And then just to kind of support why we're seeing this, when you look at pipe, you can see that there was another surge in pricing. Again, as we've been saying, we don't see a reduction in labor, in diesel, in just the ancillary pipe, proppant. All of those prices are going to remain elevated. And given where the U.S. is in terms of exporting, feeding the beast on the crude side, as well as a bit on the gasoline and LPG front, we're going to continue to see that activity because there is going to be that demand. Now, when we start looking at where spreads are, especially when we look at Oman, Dubai versus dated Brent, it's still at over $11. Again, there's still a lot of activity, but it's important to appreciate, and we wrote about this in our insights, but Agena is something that's still trading at $13 premium, and it's important to appreciate why. because it's heavy sweet. And when you look at the need for a high distillate cut, and we'll talk about distillate again in a minute, this is where we're seeing. So even though it's in Nigeria and it goes against dated Brent, it's $13 above dated Brent, which is already $11 above Oman, Dubai. So you get an idea of just how people, and by people, refiners, are scrambling for things that are going to yield a higher distillate cut. And as we said in the EIA show, we now have the data for what came out this week. So when we look at light distillate, it's fairly flat, something that we've been talking about, where light distillate is going to be flat to up. More likely it's going to continue to trend higher, with residual fuel continuing to build until we get that pivot, because there was another drop in middle distillate in Singapore from 7 million barrels to 6.8. Again, lowest since 2007. There is a clear need for more distillate, but at some point the emerging markets are going to yield and say, look, we can't afford to run diesel. We're going to have to run heavy resid or fuel oil, high sulfur fuel oil, just because we need something to burn and the cost is too high. So now when we switch over to Europe, in general, you can see that gasoline had a drop of 12. It's still fairly stable. We expect that to remain the case. We do expect to see an increase in exports coming into the U.S. again, PADD 1 being the bright spot for it. Gas oil, another drop of 38. Again, gas oil is still it's still at one of the lowest points ever and trending in the wrong direction. And this is something that we do see more imports coming into the Atlantic Basin, but again, it won't be enough to offset the fact that the gas oil and the distillate situation in Europe remains tight. And now when we look at fuel oil had a big increase of 140. And this is the problem that we're seeing in terms of just cost. So when you look at the price of fuel oil, we're going to have to see the price really, as we've been talking about, it's now 2.5. It's at the lowest spread in 2.5 years, because there's just not enough people taking this fuel oil. And as this continues to go up in storage, that's going to incentivize more of that flow into Asia, and you're going to get a little bit of that flip where India, Asian, Middle East is going to export gas oil, ultra low sulfur, very low sulfur diesel into Europe, and Europe is going to export fuel oil into those markets and in terms of that replacement side. Now, they could also recrack it, but the question is, does it make sense? Where is that premium? And just based on where storage is, you're starting to see the lopsidedness, but all of that is still pointing to a very tight middle distillate diesel market, which again is being reflected here with diesel ripping to new highs, $5.74. Again, we don't see that adjusting, and these are key reasons why we kept talking about inflation, on how we are far from peak inflation when you look at these type of numbers, especially when you look through May. So when you look at May had a little bit of a dip as we got into the end, but you saw that big surge from April. Now, when we look at June is off to the races. And just given the backdrop on diesel, we don't see that shifting. Gasoline, we do see starting to flatline and go a little bit lower. But it's really diesel that is the biggest driver, because every piece of the supply chain is touched by diesel, whether that is, the harvesting, planting and harvesting of cotton, to the moving cotton to the textile facility to get it into shape to be spun into a t-shirt or something else. Again, every piece of that is going to continue, because every time diesel is consumed, it gets just passed on, because labor and fuel is typically a straight pass-through. Now, when we look at Google mobility data, you can see that the Americas has flatlined. Europe has bounced a bit. When you look at the Asia Pacific, things have been fairly steady. And then TomTom is showing just how there's been that little bit of a slowdown. But again, we've seen that bounce back following, obviously, Memorial Day. You had a holiday in China, and now things are starting to come down just a touch. But again, we don't expect to get back to normal, as we've been discussing on the EIA show. And here's some of the reasons why. So now when we look at inflation, inflation came in at 8.6% year on year versus the estimate of 8.3%. And that was a big monthly jump of 1% versus the estimate of 7%. But as we said in April, when you look at what the previous month was, the previous month was only an increase of 3%. 0.3%. So the view was that okay, we've peaked, we're now coming down. And we looked at the data and said, well, you have rent and home prices still high. You have all of these increases now in gasoline and diesel. Where are you seeing a slowdown? Like I know I go to the store and when my personal prices have gone up again. Then I look at the regional data, the national data, the global data. I'm like, okay, but I guess everyone's looking at different information than I am. But here is where we get that surge. And as we've been saying since the beginning of the year, we expect that acceleration to remain through June. And really, it's July. And I have to be clear when I say this. We don't expect deflation. We don't expect we expect the rate of change to slow in July. But again, that could easily change, especially if we continue to see these types of moves in diesel, because we have to be, we're beholden to the data of what is it showing, how are things looking. And so far, the leading indicators on manufacturing are flatlining a bit and going sideways. Services is going up again, which is going to be a big driving point. But those are going to be things to watch as we go forward. And then core CPI came in at 6% versus the estimate of 5.9%, with the core up 0.6 versus the estimate of 0.5. Now, it's important to look at what did the yield curve do. And you see the whole curve shifted up, but the 2-year is really where it exploded when you look at that shift. And the difference between the 2-year and 10-year is showing that there is a likely recession incoming when you look at that inverted nature between the 2-year and the 10-year. Now, realistically had a flattening. Now, typically a flattening is a bearish signal because you normally get this flattening, then you almost get like a snapback, and then you get a big steepener. So this is something that, again, you saw the whole shift up, inflation moving up, the concerns being moved through. But when you consider real rates, when you look at the fact that, the 2-year is still at, 3.2%, 3.15%, when you factor in the issue that inflation is at over 8%, you're still deeply negative. So again, there's still a lot of adjustments that are going to be made in this arena. And then this, I think, is always a good thing to look at. But the concerning piece on it, and for those that have been listening to us rant on different things and different topics for a long time, know that we've been really harping on flexible versus sticky inflation. And the one that concerns me the most is the FRB, the Cleveland 16% trimmed mean CPI. This is the one that is typically going to show you where is the trajectory on the stickiness, because this is something that is a bit refined. And when you look at it, it's actually above core CPI. So the trimmed mean is at 6.5% versus the core of 6%. So when you look at this, you have to say, okay, well, the trend is typically up. You're seeing that movement. So when you look at June, which is already seeing higher prices than May, plus you get a lot of these essentially these tailwinds behind it, it's really hard to see how this is going to slow, at least in the next month. And I think this puts it into perspective on the 1-month change, but the 3-month is really starting to pivot, and how ugly it's really showing, because for the first time this cycle, it is running higher than core for the last 12 months. Monthly and 12-month trimmed mean are both the largest on record, with the data going back to 1983, to give you an idea on just those kind of tailwinds that are going to support us. And all of this is happening as real wages continue to fall. So the real average weekly earnings sank another 3.9% on an annual rate. So when you're looking at this, and it's not surprising because as inflation surprises to the upside and wages kind of holding in, you're clearly going to get this disconnect. So, but this is how people are going to spend money. And this is why when we're going to talk about the University of Michigan data, it's at a record low because people are feeling the pain. They're seeing it at the pump. They're seeing it in the store. And then they're looking at their credit cards and like, how did I just spend an extra $400 this month? And I had that moment with my wife when we were going through things, and I was like, Shona, we just spent another $600, and I was going through the data, and I'm like, we didn't buy anything abnormal because obviously you have kids' birthdays, you have dance recitals, you have graduation, so typically you're going to have some fluctuation, but when you peel it back, and I again, like I know I'm talking personally here. But when I have these conversations with people, they're all seeing the same thing. And as everyone who's watching knows, I am a huge data monkey and I love data. And it's just interesting when you see it so synced up in terms of what I'm personally feeling and then what is coming through on the data sets that continue to come out. Now, the other piece is the owner's equivalent rent, which is up at 5.1%, and it's the fastest since February 1991. And this is important because when you look at the trends, so rents are up 15.1%. You have housing, which is up 12.6%. And I got a great question on Twitter, and they're saying like, why? Like, why is CPI owner's equivalent rent only at 5.1%? And the issue with the numbers is the Fed, when they do the calculation, they look at a home purchase as an investment. So they have to convert it into owner's equivalent rent, which again, you're never going to get this number up to those levels because even back in the early 80s, we only got to 6.5%. We use the rent and the housing data as the trajectory. And when you look at how wide it's gotten, and we've shown the data on the Econ show, there's typically a 6-month lag between CPI, OER, and the housing data. So when you look at where the housing rent data is and where this is, it just shows that there is still more ground to make up. We will likely take out the highs from the 1980s. We'll more likely get to 7 to 8% before we start to see a cool off because of that leading indicator and because there still is that wide gap. We're not going to get to 15, 20% on the conversion ratio, but again, it just shows the trajectory, and this is sticky. This is not something that goes away. You don't go to your landlord and say, oh, did you see the inflation data? I should be paying you less. No, this is something that is going to remain and be a problem, especially when you look at the contributions to it. So when you look at food, continues to be in addition to it. When you look at commodities, excluding food and energy, and services. So services is the one, when you look at the leading indicators, we talked about service PMI, prices received, prices paid, brand new highs. Services is going to be that increase, with energy likely to be another addition. And then when you break it down a bit further on all other CPI components, one of the things that we've been talking about is that wasn't going away. That even as you had used and new car pricing getting better, even as you had energy tightening up, there's the other components, and the core components were going to remain, which is why we think comfortably saying we believe we'll be well over 6% as we head into 2023, which again is going to be a big problem for the Fed and their target. And this is what, when you look at what is going to drive GDP growth and you look at the consumer, well, when we look at University of Michigan, consumer sentiment for June has fallen to a record low, with consumers now feeling worse than during the great financial crisis, and the expectations component, which is that orange line, has fallen to the lowest since 1980. So you have sentiment at the worst ever and expectations at the lowest since 1980. Again, all of these things are going to put a huge damper on what is the consumer going to do? What is the consumption going to look like? And a lot of this is going to lead to gasoline, which is why we expect to see some of these pressure points. But with that being said, it's still costly for a refiner to make diesel, to make gasoline. So even though we're going to see some of that demand response, the pricing is going to be fairly sticky when you look at the problems as we go forward. And again, these are going to be some of those underlying issues. Now, when we take this and look at it from a perspective of June sentiment update from the University of Michigan for buying conditions for a vehicle, which is blue, tanked to an all-time low. So the worst time ever to buy a vehicle, according to the consumer. Now, when you look at housing for orange, it's continued to move lower, still above where it was in 1980, but again, you're still at a near record low. And then white, which is the large durables, is the worst since 1980. So again, all of this pressure is people are just looking at this and saying, I can't afford this, I'm not buying. And then the other piece, now we talked about Amazon, we talked about Walmart and some of these pressure. And this is just another interesting piece because when you look at jobs postings on Burning Glass, you can see that there has been a drop. Now, some of this could be semantics in terms of timing, but when you look at the percentages overall in terms of some of the comps, you're just seeing that, again, you're starting to see some of the cracks. So as we've been saying, and we said it on the Econ Show, we do expect unemployment to go up a bit. Not a huge surge, but again, starting to see those cracks, layoffs to accelerate a bit. And as that happens, wages will moderate. And as inflation doesn't moderate, but wages do because there's just not as much competition, that's going to increase the distance between real wages coming down when real wages should be negative 5%, based on this scenario, which is going to impact spending even more and why we're so concerned on Q3 GDP growth. So that's what we have for you today. Hopefully it was helpful. If you have any questions, you can find us obviously on Twitter in the comments section, and we hope you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.